everyone, a very good evening to everyone. So, today in this session, we are going to start some Module A questions. So, I am here asking some questions, so you have to give the answer. This will help us in brushing up our concepts. So, let's start with the journey. I hope that my screen is visible and I am audible. Everything is okay. Kindly try to give the answers so it will help you. Okay, so let's start with the class. Here is the first question, where the question first is asking about calculate the TT buying rate for British pound 1 lakh inward payment if US dollar INR is 80.10 and US dollar GBP's British pound is given. So ignore the margins. Just answer up to 4 decimal and rate to be quoted nearest 0.25 paise. So which option is correct here? See, if we see the correct answer, if we see how to calculate the cross rate here, we know that in this one, we have to understand the transaction first, since it is an inward remittance. So bank is buying British pound and giving INR, right? So we need to calculate the TT buying rate for British pound in INR. First, we have to use the cross rate formula. And here what is given? US dollar to INR is given. That we can write also 80.10 and 80.50. Right? Now bank here buys the US dollar at this amount. So US dollar British pound is also given, that is 0.6230 and 0.6240. So bank buys the British pound at US dollar 0.6240 here. So what is the formula? That is British pound is to INR. We have to find, which is equals to US dollar INR, that is the bid rate, divided by US dollar by British pound, which is ask rate, right? So how to calculate? 80.10 divided by 0.6240, which is equals to here 128.3653.846, right? Now we have to round it off to nearest 0.25 paise. So what is the rounded off value? 128.3650, right? So which option is correct here? This is the TT buying rate per British pound. So the correct answer is option A here. Clear? Which option is correct? Option A is correct here. Now the next question. I hope that this is clear. If you have any problem, you can ask. Then the next question is here. On July 1st, a customer request to book forward contract for retirement of import bill for US dollar due for payment on 15th of October. Spot rate is given, forward premium is given, spot July, spot August, spot September, spot October, and September to 15th of October is given. We have to charge the margin 0.10% on the spot rate. So what will be the answer here in the given options? So let's calculate. It's very simple. What we have to do here, first, being a merchant sale forward booking transaction, so rate we have to calculate, which is US dollar INR spot, to be taken as here 80.24, right? And what is premium payable on September, spot September? This is here 42 paisa, right? And for September to 15th of October, it is 15 paisa. So what is the total premium here? That is 57 paisa, right? So we can say this IB forward rate would be 80.24. We have to add 0.57, which is equals to 80.81, and add the 10%, 0.10% margin, which is equals to 0.08. That is equals to here 80.89. So option D is correct here. Option D is correct here. Is that clear? Now, third question. This is the second question. Now, third question. You are required to book forward sale contract for US dollar 2 million delivery third month and another forward purchase contract for US dollar 4 million for delivery second month. Given US dollar INR spot rate is there, premium quoted as under calculate rates for merchant transactions, and if the exchange margin is 0.10% is to be loaded for the purchase transaction and 0.20 for the sale transaction. Premium is given for 3 months, so find the correct option here. Which option is correct? We will do some numericals, then some conceptual questions. So in these type of question, how to solve these type of questions? Simply, first we have to calculate the rate of forward sale here, right? Then we have to calculate the forward purchase. So they are asking about the third month. If we calculate first the forward sale, that is what we have to take the spot rate, which is highest in the market, highest rate of the market, that is 80.9200, and 3-month premium is to be charged, which is here 0.2850, right? Then what is the total here? 81.205. Now we have to add here margin, which is 20% for the sales transaction. So add 20% margin, which is about 0.1618. That will equal to 81.3675. Right? Now we have to calculate the forward purchase rate. How to calculate the forward purchase rate? You can see the spot which has to be taken is the lower rate of the market in the case of forward purchase. So what is the lower rate here? 80.9100, and 1 month premium is charged here, which is equals to 0.0750. So add this, that is equals to 80.985. So now subtract that 0.10% margin for the purchase transaction. We have to subtract the margin in that case. That is equals to 0.0810. After subtracting this from this, we got 80.9050 after rounding off. So the forward purchase rate is 80.9050 and forward sale rate is 81.3675. So this is the solution. I hope that this is clear. Any problem in this, kindly ask. Next question. Now, there is a case study on the liberalized remittance scheme. As you know that it is effective from 1st of April 2025. If I give you the overview of this, education which is financed by loan from any financial institution, that is nil up to 7 lakh, right? And 0.5% above 7 lakh would be deducted. But this is the earlier rate. Now according to the new rate, up to any education loan which is financed from financial institution, in that case no tax deduction is there. For medical treatment and for those education basically which is not financed by any loan, so no tax up to 10 lakh but 5% tax above 10 lakh, right? And for any other purposes, now no tax up to 10 lakh but 20% above 10 lakh will be deducted. So according to this, this is the new questions on this basis on this. So Mr. Ajay, who is studied in a university of USA, and he has availed a loan of 10 lakh rupees from a bank. He wants to remit this amount to US for his study. So how much TCS will be paid by him on this transaction? And his PAN card and Aadhaar card is available. So tell me the answer, that which option is correct here? Like, what is the answer here? What is the correct answer here? See, if here he availed a loan of 10 lakh rupees from a bank, so in that case LRS for education purpose, if the amount being remitted is from education loan obtained from a specified institution, as it is mentioned here, from a bank, right? So in that case the TCS rate would be nil. No TCS applied here. Nil is the answer, right? Because he take the education loan from a bank, right? Now in that next case, Mr. Mohan study in a university of USA and he has 25 lakhs in his saving account. He wants to remit 15 lakh rupees to US for his study. How much TCS will be paid by him on this transaction if his Aadhaar card and PAN card is available? So simple, 15 lakh he want to remit, right? We have to deduct 10 lakh from this 15 lakh as per the rules. That is, we got 5 lakh. Now we have to apply the TCS on this 5 lakh, which is how much percent? 5%. And 5% means 5 lakh, 5% is equals to 25,000. So this is the answer here. Is that clear? The answer is 25,000. Now the next question. Mrs. Shanti is sick and he wants to visit US for his treatment. He transferred rupees 12 lakh to hospital for his treatment. How much TCS will be paid by him on this transaction? How much TCS will be paid by him on this transaction? For Mrs. Shanti. See, 12 lakh to hospital he want to transfer. So 12 lakh is more than 10 lakh. We have to deduct these 10 lakhs from this 12 lakh. What is the leftover amount? 2 lakh, right? And in that 2 lakh we have to apply 5%. And what is the 5% of 2 lakh? Is 10,000. So answer is 10,000 here. Is that clear? The answer is 10,000 here. And the next question, Miss Geeta studied in a university of USA. He has availed a loan of 12 lakh rupees from a bank. He wants to remit this amount to US for his study. How much TCS will be paid by him on this transaction? If his PAN card, Aadhaar card is not available, so how much TCS will be paid by him? Try to give the answer if you know the answer. Now, as he, Miss Geeta, who is studying in university, he has availed a loan of 12 lakh rupees from a bank. Again, the thing is there, whatever the LRS for education purpose, if the amount being is remitted is from education loan obtained from a specific institution, whether amount is up to rupees 10 lakh or above 10 lakh, the TCS rate will be nil, even in the case of normal PAN or inoperative PAN. So the answer is always nil, right? So answer is nil here. No TCS will be paid by him, right? Then next question, Miss Dipti wants send money to USA for maintenance of her family under LRS, she wants to transfer rupees 8 lakh. How much TCS will be paid by her on this transaction? How much? Yeah, no TC, like for the Gita, there will be no TCS because obviously that is not applied here. But in the case of Deepthi, there is the answer 0. We can say 0 here, right? Because the amount is below than 10 lakh. So answer is here only 0. If this type of question is there in the examination, in this we have to write nil and in this we have to write 0, right? Then next question. Which of the following statement is true regarding rupee account maintained abroad by authorized category first banks? See, authorized dealers are those persons, banks, institutions who got the license from the RBI to handle all the forex exchange transactions. So which of the following statement is true here? See, we know that RBI permits authorized dealers, category 1 banks to freely manage all the things, right? And yeah, all the things. So basically they can manage rupee account abroad for operational convenience as long as they are non-interest bearing accounts, or they are not in the names of Pakistani banks, and the bank board has appropriate policies in place. So however, we can say opening a rupee account for exchange houses which are used for private remittances does not require prior RBI approval. But here the correct answer is option B, which is true regarding the given statements. Authorized dealers category first banks can open or close rupee account in the name of overseas correspondent without RBI approval, but except for Pakistanis banks. So option B is correct here. Under the FEMA 1999, which of the following best illustrates foreign exchange transaction? In the given option, which one is the FEMA's transaction? See, FEMA defines foreign exchange as any foreign currency which include deposits, credits, balance payable in foreign currency, or any instruments that are expressed in Indian currency but payable in foreign currency. That is also, we can say, foreign exchange, right? It is in the definition of foreign exchange. So if we see the all option, first option is completely a domestic transaction, and in the option B we see here an Indian exporter receives payment in US dollar for goods sold abroad and converts it into the Indian rupees. That is, we can say, the foreign exchange transaction. So this option is correct here. Option B is correct here. Great. Now, Mr. Desai sends US dollar 20,000 to his son studying in the US for tuition and living expenses. Later, he uses the same US dollar 20,000 to buy listed shares on a foreign exchange in his son name. So, which statement best describes the classification and compliance issue under FEMA as given above? we know that a current transaction is what? Which includes payment connected to travel, family, maintenance, education, etc. The remittance for tuition maintenance clearly falls under current account. And what is capital account transaction? That alters the assets and liabilities outside the India, right? In abroad basically. So if we say about the section 10 subsection 6, section 10 subsection 6 of FEMA tells about what? Misuse of foreign exchange. If foreign exchange was acquired from authorized dealer for a specific purpose and not used for that purpose, it can be treated as contravention. So here Mr. Desai used money remitted for a current account purpose to buy the capital asset. This is precisely the kind of misuse of section 10 subsection 6. So we can say the correct answer is the remittance for education is a current account transaction, but purchasing share abroad is a capital account transaction. So using foreign exchange drawn for one purpose to do capital transaction, that may contravene the section 10 subsection 6. So answer B is here correct. Next question. I hope that this is clear. If Priya, who is an Indian resident investor, she is an active trader in global commodities. She approaches her bank to remit $25,000 under LRS to maintain the margin money with New York Mercantile Exchange on her future trade. So as per the authorized dealer, what should the bank do? Obviously, we know that under the schedule first of non-permissible remittances for margin or margin calls to overseas the exchange or counterparties that are not allowed under schedule 1, right? So here we can say, even though the LRS allows the investment abroad, margin payments involve speculative elements, but RBI prohibits to make the unregulated capital flows. So obviously authorized dealer have to deny this transaction. So why does RBI restrict margin payment? Just because of speculative and volatile capital outflows. That's why RBI restricts the margin payment. So option B is correct, in which decline the request as remittance towards margin money is prohibited. So option B is correct here. Again a case based question. Neha has secured admission to a prestigious overseas university which requires her to deposit $3 lakh as an upfront fee to confirm admission. Neha is resident in India and approaches an authorized dealer bank for release of the full $3 lakh under the LRS. So which statement is true here? No, in this one option B is correct. Margin money is prohibited. Not A is correct. Option B is correct, because margin money is still not like allowed by the RBI. Why? Because they speculate and volatile the capital outflows. That's why RBI restrict margin payments. Right? In this one, what will happen? There is confusion between A and B, right? Which option is correct according to A option or B option? See, case, we can say that uh, for the medical treatment or for the education purpose, remittance is allowed under LRS only 2,50,000. But if in that case Neha provide the estimate or the proof from the university in front of RBI, so RBI will approve additional money also. So here we can say that, yeah, AD may release up to $250,000 without additional documentary proof. There is no need for the limit $250,000. But if she needs $50,000 excess, so she have to prove that thing. She have to submit suitable documentary evidence, right? In that case, authorized dealers will allow to remit more than this amount. So we can say that option B is correct. In the case of medical treatment or in the case of education, up to $250,000 is allowed with the approval, but if anybody need more than this, they have to show the evidence. So that's why option B is correct. Next question. A medium size exporter does not have hold a comprehensive policy but has signed a short term export contract with a new buyer. So which ECGC policy would provide protection against both commercial and political risk for this single transaction? So what is ECGC? That is Export Credit Guarantee Corporation of India Limited. It is an export promotion organization just to improve the competitiveness of the Indian exporters by providing them credit insurance and all the other facilities which are important for the exporters to survive in the competitive market. That is the main work of ECGC. Yeah. So the correct answer is specific shipment comprehensive risk policy. Why? Because specific shipment policies cover commercial and as well as political risk for export on short term credit, which is less than or equal to 180 days. These are suitable for those exporters who do not hold standard comprehensive policy. So comprehensive risk is here, that includes the political and as well as commercial risk. So that's why option B is correct here. Now there is an Indian textile exporter ship goods to the buyer in the Turkey. Before arrival, a sudden coup in Turkey results in import payment suspensions. So payment suspensions. So simultaneously the goods are delayed due to the strike at the destination port. Identify the correct combination of risk. Here we have to keep this thing in mind about the payment suspensions. Basically, coup is also the we can say it's some type of voluntary or violent overthrow of the government or against the government. So here we can say that political risk is what? Where government imposed payment restrictions. These are called political risk as they arise from actions of the importing country's government, not from the buyer's insolvency. And what is the shipping risk? When the port strike cause delay, that falls under shipping risk. So it is the combination of political risk as well as shipping risk. Political risk and shipping risk. Which Which of the following ECGC product is most appropriate for a bank that regularly extend pre-shipment and post-shipment credit to multiple exporters and want protection against default by those exporters? Which of the following ECGC product is more appropriate? Then we will do a question related to numerical. No, Praveen sir, there it is mentioned, see, the goods are delayed due to the strike at the destination port. That, because of that, we have to say that this is strike is here. If a strike is not related to the political issues, but if any good is delayed due to strike, that means there is a problem at the shipping port, right? So that's why we have to include that risk in the shipping risk, because the port strike causes the delay, that falls under the shipping risk. That is not related to political risk, but that comes under in the category of shipping risk. That's why we mark here the shipping risk. Yeah, strike is okay, but it is not related to the political right. That is correct. That is not related to the political things, but these both are different risk. So here the answer, which of the following ECGC product is good here? We know that CAIIB, whole turnover packing credit, that is completely designed for banks, not for the exporters. Why? Because it provides cover to the banks against the losses if there is non-payment of the exporters under the pre-shipment facilities, which is basically packing credit. So basically ECAIIB protect the banks against the default in post-shipment credit. So this whole turnover concept means that cover automatically to all the eligible account without the need for case by case approval. So that's why we can say here ECAIIB whole turnover packing credit is correct answer, right? I hope that this is clear. Then do this question. If a dealer enters into a spot deal on Friday 5th of November 2021 to buy $5 lakh at 75 rupees 0.2500 paisa $, from another bank, spot settlement occurs after 2 days, 2 working days. We know that. Ready, immediate. Ready means cash deal, which is basically immediate, happens immediately. Tom means tomorrow. Spot T plus 2 days, and forward deal is any date after the spot date. So find the value date here, and what is the INR amount payable by the dealer, and assume Saturday, Sunday are holidays for both the markets. So what is the answer here? I think easy. See, here the date of deal is, date of deal is the 5th of November. So obviously after 2 working days, which is of 9th of November. So settlement date is 9th of November, and what is the amount of INR payable? Then we have to multiply this amount by this, which is equals to, I think, 37 lakhs 62,500 rupees. So by multiplying this is the amount which is INR payable by the dealer. Yeah, great. Okay. If an exporter has a standard policy but now expects high value recurring exports to large overseas buyer, the buyer LC issuing bank is ranked 18,000 in the banker's almanac. So the exporter wants to separately insure this buyer to avoid paying duplicate premium. So which ECGC policy and cover type should be selected here? I think what is the meaning of buyer exposure policy? Buyer exposure policy is only for the large exporters, right? Because they ensure exposures on a specific buyer. It provides flexibility to cover all the shipments. So, buyer will cover all the things under one policy. Since here the LC is opening a world ranking which is less than 25,000. So failure of that bank is also covered under the commercial bank. And so we can say this standard policy exclude this buyer to avoid any double coverage premium. So both is there, buyer exposure policy, commercial and political risk, both. Political because here the situations where exporter wants to cover LC based transactions only at the lower premium. Yeah, option B. Great. Under the IT enabled services, single customer policy cites which of the following statement is incorrect? What is the meaning of sites? Basically, in sites generally premium is payable on the approved loss limit. And what is the approved loss limit? Which covers 80% of the loss limit, which is valid for only 12 months per buyer. So which option is incorrect? Premium is calculated only on the total invoiced value of the services that is rendered. So option B is correct here. Now let's do this case study here, which is export order is given, freight insurance is given, PCL margin is given, FBD margin is given, bill value submitted, documents drawn on after 30 days, bill realized date is given, bank interest rates are given, exchange rates are given here, premium given, foreign bank charge given. So we have to calculate the amount that bank allows as PCL. So if I just a minute, keep this all thing in a one slide, that will help you. Now calculate the here amount that bank allows as PCL. What should be the amount here? See, what is the formula of this PCL, we know that this free on board value and subtract the margin percent, right? So that is here, what is the order rate? 50,000. So that 50,000 subtract the margin which is there 12%. Margin is there. First we have to calculate the FOB value to calculate this. Okay. So for this, what we have to do, we have to apply the formula of FOB. That is our CFR rate, and we have to subtract freight and insurance percent from this. That is equals to about 1 minus 0.12. We can write it as 0.12. That is equals to US dollar 44,000. Right? Now, what is the margin given? That is given 25% on FOB. So, how to calculate the PCL advance? That FOB value, then subtract the margin, and here we got US dollar 33,000. Now we have to convert this into the INR. So what is the INR rate here? You can see the buying rate is 75.20. So 33,000 multiplied by 75.20, that is equals to rupees 481,600. This is the our FOB value, means amount that bank allows as PCL. So this is the question from the where we have to calculate FOB or about bill buying rate, FBD. They can ask these types of question. I saw this question in one previous year analysis, so that's why I put it here. I hope that it is clear. So what is the primary purpose of EDPMS? What is the primary purpose of this EDPMS? EDPMS is a RBI detective, right? Export detective portal, because it checks every shipping bill, every soft tax form, every remittance, and obviously it ensures that no export proceeds go missing. So if exporters don't bring the money back in time, so this EDPMS waves that red flag. So that's why the main work of this EDPMS just to monitor and report the export data from customs, STPIs, special economic zones, to RBI and authorized dealer banks. So this option is correct here. Is that clear? Now, you are an advising FPI, foreign portfolio investor, which eyeing India's gift city, which is in Gandhinagar, Gujarat. They ask what makes trading there special. Which of the following is not a relaxation or benefit available to FPIs at gift city? Great. So basically, these FPIs, foreign portfolio investors, in the case of gift city is just like in the gift city, FPIs enjoys no type of commodity transaction tax, and they also get a waive from a short term capital gains, usually 30%, up to 30%, and there is no extra paperwork. So basically, in this case, we can say as a portfolio investor, there is one thing: FPIs have to required submit additional document before each trade. That is completely not required, because FPIs are allowed to trade in securities and commodity derivatives. FPIs are also exempted from security transaction tax, and also they enjoy waiver of short term capital gain tax on derivative trading. So the only answer is option C, where FPIs are required to submit additional documentation before each trade. They are saying not. So this is the correct option, which is option C. Right. Next question. At your IBU branch in Gift City, a client walks in and says, "Hi, I would like to open a saving account and withdraw some cash." So, what should your banker brain instantly say? Obviously, an IBU is not a everyday type of bank. It is more like a corporate and institutional banking zone, but no cash counters are there. So they only deal in current account and term deposits only. So we can say that there is no cash available and no cash counters are there. So what is the correct answer? Simple. Cash transactions and saving accounts are not permitted here. Right? Okay. Next question. Mr. Khan, an NRI, pledges his NRI deposit to help his brother company in India obtain a working capital loan. So, which of the following condition must be observed by the bank under the FEMA? In this case, basically, bank may allow loans to the third parties against any NRE deposit, which is subjected to margin and according to the norms. So NRI depositor cannot receive any forex benefit or any consideration just for pledging. These loan proceeds cannot be repatriated abroad, and they must be used only within India just for the permissible purposes. So you can say here which of the option is correct. There must be no direct or indirect foreign exchange consideration for the pledge. So option C is correct here. Yeah. Yeah. Which who among the following qualifies as PIU under the FEMA? Simple. Here option B, because if any child, grandchild, great grandchild is there, so we can say Suzanne, a British citizen whose grandmother was born in India. So simple option is B here. And what is the work of SWIFT? Where more than 11,000 banks are connected with SWIFT, which is one of the secured communication system for financial institutions. So correct answer is option B. Now let's move to the numerical part. Let's do some numerical. So Mr. X, just ignore this line, I just cut the options just to make the question question without option. So Mr. X wants to remit $15,000 for purchasing a property in USA. He therefore requests his bank to remit the amount by debit to his account. On the date of the remittance, the US dollar INR rate are as follows. TT buying rate is this, TT selling rate is this. So what is the amount of TCS that the bank will deduct in order to make the said remittance of US dollar 15,000? Which option is correct here? Like what is the correct answer here? Simple. Here this person wants to make a payment of US dollar 15,000, right? In this case, bank will sell applicable TT selling rate will be this 86.55. So what is the amount? Just multiply it by $15,000 and the answer is rupees 12,98,250. Now we have to deduct the TCS. How much? 10 lakh. What is the TCS deduction? Reduce the 10 lakh from this. That is 2,98,250. Apply 20% here. That is equals to 59,650. So this is the answer. 59,650. Clear? Okay. Which of the following differentiate forfeiting and factoring most accurately? Factoring and forfeiting. What is the factoring? Important concept, factoring. Factoring is generally, we can say that it is a type of financial transaction where business sells its the unpaid invoices to a third party, that is called factor at discount, right? That is the concept of factoring. And what is forfeiting? Forfeiting generally means a trade finance method where an exporter sells medium to long-term foreign account receivable at a discount to specialized financial institution. That is called a forfeiter who received immediate cash. So which of the option is correct here? I think option B is correct. So we can say basically for the factoring, the duration should be short term, and for forfeiting, it is basically medium to long term. And security, if we talk about the security, factorings are generally open account, and forfeiting are backed up by the accepted bills or any type of LC. Forfeiting is one time, and factoring is ongoing and often short term. So we can say here option B is correct. Then Priya in Mumbai sells machinery to Ahmed in Sharjah under DAP Sharjah. So when the truck reaches Sharjah, customs official asks to import duty and taxes. So who is responsible to paying these duties? Is it Ahmed, or is it Priya, or both, or the transporter? Yeah, obviously, who is responsible? Buyer. And who is buyer? Ahmed. Because under DAP, that is delivered at place, Priya have to deliver goods to the named place, which is obviously the Ahmed location, that bears all the risk and cost till goods reach the destination. However, import duties, taxes, custom clearance in the buyer's country are not the seller headache. These all are the Ahmed responsibility. So if Priya chosen DDP, which is delivery duty paid, they have uh, they have to be handle everything, even the custom duties. So DAP is just for duty at place, where buyer pays the duty, and DDP is the duty, basically seller pays the duty. So the option B is correct. Who is Ahmed? Okay, do this question. Sunrise Exports raised a ECB under the automatic route but forget to report their first drawdown and obtain a loan registration number before using the funds. They later submitted all the forms and asked RBI to regularize the delay. So which of the following is correct regarding such delay? And one more thing I have to add in the previous question. Just first do this question. So here the correct option is option C. Why? Because for all the ECBs, the borrower have to report the first draw down and obtain the LRN before using the funds. If they forgot, RBI allow the delay to be regularized by paying the late submission fee. So ECB itself does not become invalid. So RBI would not cancel the ECB. They simply charge a late submission fees based on how late the reporting was. So the correct answer is option C, which is the delay can be regularized by paying late submission fee as per the extent of delay. So option C is correct. And one more thing I have to add in this question. So we have learned about DAP and DDP. What is the meaning of EXW? EXW is basically X works. X works means named place of delivery. Named place of delivery, because every time in every cycle these type of questions will be there. That's why I explain you this, in which EXW, seller responsibility is very minimum, whereas buyer responsibility is maximum. So buyer picks up goods from the seller's factory and seller just keep the goods ready. That's it, right? And then we have FCA, which is free courier. FCA is free carrier, means you can say seller deliver goods to the carrier nominated by the buyer and risk transfer when goods are handed to the carrier, right? And FAS is free till carrier arrives, where seller brings the goods alongside the ship at port, and buyer loads it into the ship and takes over all the cost and risk. So Incoterms are very important. So do this question, which is about the Ravi, who is the CFO of Global Desi Limited, who received foreign equity investment from Japan. Instead of filling the report, he is saying, it's okay, I will do it someday. Months later, RBI sends a notice about late submission fees. His intern whispers, sir, we supposed to file it through firm's portal. So what is the perfect answer here? Where and how Ravi have reported this FDI transaction? Obviously, all FDI reporting, whether it is about new shares, whether it is about transfers, whether it is about right issue, conversion, anything, they must be filed online on the firm's portal using the SMF, that is single master form. And these all the filings goes to the RBI through the company's authorized dealer bank. So that's why option B we can say here correct, online to the RBI through authorized dealer bank using SMF on firm's portal. So option B is correct. So these are the questions, some questions from module A, and I will upload PDF also, some additional questions for you. You can go through with these questions also. I hope that this session is useful for you as BFM exam is coming. And tomorrow we will discuss module B, all the questions from the module B, numericals plus conceptual question. And if anything is there, any problem in any question, you can ask. And if you like this session, kindly give the like and do the comment and subscribe to the channel. So thank you so much. Let's meet tomorrow for our module B. Till then, take care everyone and have a good day on. Thank you.